What's up, everybody? Welcome to another episode of Hidden Forces with me, Demetri Kofinas. Today, we speak with Jim Grant. Jim is a legend of the financial newsletter industry. Born in the year in which interest rates made their mid-century lows, Jim seemed almost predestined for a life in finance. A Navy man, standing at 6'5", Jim is a giant on Wall Street. Once the editor of the yield column in Barron's, he would leave in 1983 to found Grant's Interest Rate Observer 2 years after the risk-free rate touched just under 20%, a level that seems nearly impossible to fathom in today's world of near zero and even negative rates. Having observed, reported, and opined on markets for almost 50 years, Jim represents a bastion of not only experience, but wisdom. In this episode, we stop to listen. We stop to remember a time in which the extraordinary measures and unprecedented actions of our monetary and fiscal authorities would have seemed unimaginable. We take a hard look at money. How does the shadow of wealth find its value? How is the rate of interest determined? And what is the role of financial markets in facilitating the discovery of that value? What happened in 2008, and what are the consequences realized and yet to be discovered of those very extraordinary and unprecedented actions taken by governments around the world to douse the flames of deflation, contain the contraction, and prevent the discovery of prices? What does the future hold in 2017? What investments does one make, and where might one find value in these oceans of uncertainty? As always, you can gain access to reading lists put together by me ahead of every episode by visiting the show's website at hiddenforcespod.com. Lastly, if you are listening to this show on iTunes or Android, make sure to subscribe. If you like the show, write us a review. And if you want a sneak peek into how the sausage is made, or for special storylines told through pictures and questions, then like us on Facebook and follow us on Twitter and Instagram at Hidden Forces Pod. And now, let's get right to this week's conversation. So, Jim Grant, I am very excited to have you in my studio for the first time in four and a half years. It turns out.
It's been that long?
Yes, it has. Yeah. Not this studio, a different studio. And in fact, you may not remember the title. So it was 4.5 years ago that you were on my television show, Capital Account. You may not remember, or perhaps you do, the title of that episode.
Well, refresh my memory, Demetri.
Honey, I Shrunk the Yield Curve. And so that episode was about a question that I had posed to you then and to the audience as well, which was one of not so much was the Fed culprit in the low rate environment that we had and continue to have, but the question was the Fed the culprit prior to the crisis? In other words, was it the accommodative monetary policy prior to 2008 that led to the boom, of which the subsequent bust has created such perversely low rates, or is the Fed today that is keeping the rates low? And that's something that I will want to get into in this discussion, but I think I don't want to take our audience's knowledge for granted, and I want to...
Nor mine, I hope.
No, I'm not taking yours for granted. But the very first question I have for you is, let's do a top level here, which is interest rates. So you are the publisher of Grant's Interest Rate Observer. You're also the podcast host, I should mention, of...
To be sure.
Which is pretty
All,
awesome.
as you know, Demetri, we all have a podcast. You have to have one.
It's the latest thing now.
But, you're dating me because I called my publication Grant's Interest Rate Observer. That was when we had interest rates. And I got to tell you, they were fabulous. This was 1983. And within a year, the founding of Grant's, you could, and some did, invest for 30 years in U.S. Treasury securities and earn almost 14% for 25 of those 30 years guaranteed. Think about it. And now, Demetri, so different are the times in which we live that some people, some sentient human beings with money are lending those mostly euros and some yen to sovereign governments deemed solvent through courtesy. They're lending these governments money and paying the governments for the privilege of taking their money for 2 or 3 or 4 years. Is that extraordinary?
Well,
you pay them now.
You're talking about negative interest rates. So Let's talk about that. First of all, let's define. Now, you were the editor of the yields column at Barron's, correct? And then you started Grant's Interest Rate Observer when interest rates still existed. These are things now that there are children born today that have never seen an interest rate. Never seen an interest rate. So what is an interest rate for those children and for those coming of age, or even those who may have forgotten because it's been a long time since we saw one? What is an interest rate?
An interest rate is the cost of borrowing, or the pay for lending.
Or as you've said before, the price of money.
The price of money is one way of looking at it. Interest rates, they are prices first and foremost, and they are arguably the most important prices in capitalism. Certainly they are the most useful. They, for example, they help to define risk. If someone pays a great deal to borrow, that person you can kind of assume is not such a solid character financially. So interest rates help define risk. They also help to set investment hurdle rates, meaning that you feel you ought to earn something in excess of what we might call the risk-free rate for taking the chance of building a plant and manufacturing something in it. So interest rates help you define the level of profitability you think you deserve for the risks you take and the work you do to produce something. And then interest rates help you to understand the present value of future sums of money. That's called a discount rate. How much is a dollar that you will receive in the year 2027 worth today, given the expectations you might have for inflation, for example? Another way of looking at rates is that they are the reward for thrift or for waiting. We are impetuous, we human beings. We like to have what we want to have now. And if you choose to forego that immediate pleasure and wait, the rate of interest might be seen as the reward for your lack of impetuosity. That's another way of looking. It's kind of a moralistic way of looking at it. And it's funny that in this day and age of Amazon Prime and everything available at an instant, that interest rates are historically low. In fact, Demetri, I'm going to tell you an astonishing fact.
What's that?
Whether you want to hear it or not. And
I do want to hear it.
We live in a time of 5,000-year firsts in the history of interest. Now, interest has been a long-established phenomenon, and there is a page-turner called The History of Interest Rates.
Homer and Scylla.
And Dick Scylla is the still living co-author. And I called up Dick and I said, Dick, tell me, we have today negative interest rates in Europe and Japan, and you are an authority. You've written this book with Sidney Homer, and I have read many pages, although I confess not every single page. Tell me, have we ever before in the recorded history of interest rates seen a negative, substantially negative long-term interest rate? And he said, no.
Never in the history of interest rates.
Yeah, interesting, no?
Well, it speaks to the expediency.
Yeah. Yes, it speaks to something. I'm not sure.
Oh, well, it's interesting what you say. You said many interesting things. You identified many factors that go into the pricing of interest rates, one of which I find interesting and compelling, which is this notion of deferring towards the future the proceeds of today's output. The use of interest rates, the existence of interest rates, motivates people to work more today than they would otherwise because they can reap the rewards of that work in the future. And so there is that component to interest rates.
Well, there's a big time element, isn't there? I mean, take today's little tiny midget interest rates. You can scarcely see them. You need very strong spectacles to make out today's interest rates. So what do? Well, they do two things, perhaps. One is that they bring consumption forward in time. You could, before lenders wised up, get a very cheap car loan and buy that ride you wanted today rather than wait a couple of years because the terms and conditions were so compellingly favorable. So interest rates, to a degree, stimulate, but they stimulate, arguably, not by creating something new, but by borrowing from the future. And something else that very low interest rates do is a little subtler, and that is that they postpone the recognition of failure. In business, if you are kind of a marginal business and you are not quite making it, but almost making it, and you go to your bank, and because rates are so low and because capital is so accessible, you borrow and prolong the life of an enterprise that otherwise would have gone out of business. Think Radio Shack, for example. The Onion some years ago, in fact, 2007, had a very funny piece. It was a fake interview with the then CEO of Radio Shack, and the imaginary interviewer talked to the real, though imagined in his presence, CEO of Radio Shack, and said, "How do you stay in business?" And the guy said, the CEO said, I have no idea. How can we sell enough extension cords and strobe lights to stay in? I have no idea how we do it. I wouldn't be sitting behind this desk, in effect, if I couldn't borrow the money to sustain the corporate life. So Radio Shack lived longer than it might have lived in a time of higher rates. A friend of mine likens meaty, substantial interest rates to kind of a shot clock in basketball. Way back when, in the early 50s, there was no shot clock, and the early NBA would stage games that ended in like 15-12, like an adult game of keep away. People could pass the ball back and forth, and the audience would either fall asleep or leave at halftime, and TV ratings plummeted. So they put in a shot clock, to force action. And substantially real, meaning above the rate of inflation, interest rates, by imposing a cost on borrowing, a real cost on borrowing, by attaching a real value to money, I say force economic action. So in that sense, the very, very low rates may not at all be stimulating, but rather depressing.
Well, we're going to talk about that because you actually had you've mentioned this before, but there's an article that I came across ahead of this interview in the National Review where you talk about this sort of paradox. And I think it's relevant to our discussion, especially in the context of this question that I want to get to, which is, we're talking about what interest rates are. Interest rates are the price of money. They're the cost of credit. Prior to the Federal Reserve, they existed, and they existed long since, as you mentioned with Homer and Scylla. They've existed for centuries. It's not something that depends on a central bank to exist. So I guess let me ask you this question, and this will bring us to the question of what is the Fed and what is the role of central banking. How were interest rates set prior to central banks?
Well, David Ricardo, the great early 19th century economist, had a theory that interest rates really existed, just as you said, Demetri, independently of central bank action. Rates, said Ricardo, were a reflection of the profitability of enterprise. And the more profitable business was, the higher the rate of interest that willing borrowers would pay, because it paid to borrow. And notice that, said Ricardo, that rate of interest established in the market as a reflection of the profitability of capital had nothing to do with the rate that a central bank charged on an overnight loan or a week-long or a 90-day loan. This was an economic fact independent of pure monetary considerations.
The price of credit was a price like anything else, and it was something that banks could extend. And the extension of credit was the process was part of the process through which the price of credit was determined, which is the interest rate.
Right, correct, all correct.
And so now in this world of central banking, since 1913 until 2008, although it's gone through iterations, there was a sort of a way in which interest rates were set. And that has traditionally been open market operations, which is the Federal Reserve. Correct me if I'm wrong there.
Well, no, again, to borrow from the eminent late David Ricardo, rates were really never, said he, and I think I tend to agree, never exactly set, except in a very isolated part of the money market by central banks. They were set by human beings transacting, deciding what was a fair rate, what the market will bear. Now, the Fed came into existence, as you say, in 1913, so the United States was around a long time before the coming of our central bank. And rates then were set, as the price of apples was set to a degree.
Were they set right away? When the Fed came into operation in 1914, did they immediately?
No, the open market operations came soon after the Fed was founded, but not immediately. If I remember correctly, I was just a trainee at the time, Demetri, but if I remember correctly, open market operations came into being because the Fed needed to make money to turn on the lights and pay the help. They were a way of earning money for the central bank, which is then rather more independent of the government than it has since become.
Well, it was a question the rationale behind the setting of interest rates is something that has always perplexed me. It's something that I've investigated in at least one interview with a former vice president of the Federal Reserve, and he was not able to give me a clear answer as to why the Fed needs to set interest rates. But in order to move to this point, which has to do with the mechanics of interest rate setting, sort of the traditional way that we know that the Fed sets the Fed funds rate, which is the risk-free rates, the rate at which basically banks can lend overnight or borrow overnight, is through something known as open market operations, which is the Fed basically coming in and out of the market as need be in order to adjust the supply of money accordingly in order to make sure that rates fluctuate within a certain level that they deem to be ideal, or whatever it is that they've set. Is that a fair?
Yes, that is entirely correct.
Of course, there's been an evolution in that. There's been forward guidance and all these other tools, these Federal Reserve tools that they've developed. But certainly since 2008, the entire model has gone out the window. The entire Fed funds market has changed. Banks have, you've talked about this at Grants, the amount of excess reserves on bank balance sheets is even more sort of astounding to see than just the expansion of the Fed balance sheet. The excess reserves, I think, have gone from roughly $1 billion to $2.2 trillion or something like that. So my question really is, how do we think of interest rates today? And when I say, again, interest rates, I do mean the Fed funds rate, which is sort of the risk-free rate, the foundational rate in the market.
Well, I think the way to think about rates today perhaps is to compare them with rates as they existed in the money market before the advent of the Fed. And 105 years ago or so, before the Fed came into existence, people would trade money market balances on the New York Stock Exchange as they traded common stocks. And there was a post at the New York Stock Exchange, the money post, at which people would buy and sell short-term balances, and that rate was very volatile. It varied according to the season, it varied according to the business cycle, and it was more or less a free market rate. That was then. So today, the Federal Reserve is in the business of establishing short-term money market interest rates to advance some national interest, as the Fed itself defines that interest. The Fed is in the business to promote full employment. It's in the business to establish price stability, so-called. It's in the business to promote prosperity. And it thinks it can do that by the manipulation of one or more rates of interest. That's its essential remit. And I think thoughtful people are going to wonder why, if interest rates are prices, why they should be controlled where we don't control other prices. And we have, in fact, in modern American history, attempted to control all prices. We did so in 1971 and 1972 under the Nixon administration. Nixon imposed wage price controls, a very radical step that I think is pretty universally now regarded as a pratfall, as a failure. So the question hangs in the air, Demetri, is why people persist in assuming, without examining this assumption, that it's a good thing to control interest rates. I'm not sure it is. I think that what we want is kind of free-range, farm-to-table, organic interest rates, not the hothouse supermarket variety of government-manipulated ones. So when I'm president of the United States,
or chairman of the Fed,
whichever comes first, I will agitate for organic interest rates, we'll call them, just to get the green people on board too.
I know this is, again, what you're best at, Jim, and I think what people love to hear from you is to sort of sermonize, I think, in a way, on interest rates. But you also, at Grants, cover a lot of the minutia of the way the system is today. And one of the things that's in the news that is now sort of, it's been talked about for a long time, has been this notion of unwinding this balance sheet. Now, one of the ways I think about the Fed balance sheet is that it's a visual representation of the financial crisis. On that balance sheet, you can see the actions the Fed took in 2008. You can see sort of the failures of the financial system. We've been carrying those assets on that balance sheet since 2008.
Well, to back up a step or two, a balance sheet is a representation of what an entity owns and what it owes. So the Fed is a bank. That's its genus and species. It's a bank, a central bank, and its balance sheet shows assets and liabilities conventionally. The assets comprise mostly Treasury obligations, emissions of debt emissions to the federal government, notes, bonds, mortgages, the like. Liabilities, what it owes. Well, those are dollar bills, Federal Reserve notes, and deposits of banks at the Fed. Those are what the Fed owes others. Now, when you think about a Federal Reserve note, is that liability? What's that? What is it? You wonder whose liability is it? It's a piece of paper.
Talking about dollars, basically.
Yeah. So this is a little bit of a historical echo. A Federal Reserve note. A note is a promise to pay. It's a debt obligation, right? So it comes from the Federal Reserve note. It comes from banknotes of yesteryear. A banknote was a claim on something tangible, namely on money itself. A note was a promise to pay money. What was money? Well, money was gold and silver. So so Federal Reserve note today is the expression of the historical evolution of money from of something that was grounded in a tangible thing, was itself a tangible thing. Money was gold, and to today where money is increasingly dematerialized. A Bitcoin, the private sector's own invention, is something you can't see, touch, heft, smell. It exists in the cloud or wherever such things exist. It's a digital expression of somebody's idea of wealth and scarcity. It's a very interesting proposition, the nature of money. But the Fed's balance sheet is, just as you say very well, is a pictorial representation of the crisis. Its growth certainly is a representation of the crisis. The nature of the materials is an expression of what we all accept to be money and debt.
Interchangeably so in today's world.
Yes, yeah. Well, in times past, the money and debt were very separate things. Money, as I say, people say that gold backed the dollar. No, gold didn't back the dollar. Gold was the dollar. Silver was the dollar. A given number of ounces or of units of precious metal was in fact money itself. And that of course has changed over the past 100 years, gradually and by degree, until we've demonetized everything except for the power of the state.
So I mean, this is a great philosophical conversation, and it's something that I think people ought to reflect on. But I'm very curious about this question of the unwinding of the balance sheet. And I bring it up why? Because we've been told that we shouldn't be concerned about the actions the Fed took. If you look at the Federal Reserve balance sheet, since basically from the founding of the Fed to today, to 2008, those balances have grown, but they've grown gradually with the rate of inflation and with the growth in the economy. We never saw anything like 2008. And we've been told that it's not something that they've had to deal with before, but it's not rocket science. We shouldn't worry about the, normalization of the balance sheet. You guys have done some work at Grants looking at this, thinking about sort of how the Fed is going to go about doing it. We've heard things like caps. We know that the Fed pays interest on excess reserves. That goes into this whole bundle. But what is your view? Do you think at all about how the Fed is going to manage this?
Of course. Some years ago, in 2009 maybe, or in the early days of what we call quantitative easing, that being a fancy phrase for really materializing dollar bills or the digital expression of dollar bills out of thin air. The Fed does this in a way we can talk about if you like. But at the start of this program, this unprecedented program of monetary materialization, prestidigitation, magic making, at the start of this, Ben Bernanke, then the Fed chairman, got on 60 Minutes, and the correspondent asked him, "Can you reverse this? Can you stop this? It's like the Sorcerer's Apprentice. Are you sure that this can be stopped?" And he said, "Oh, certainly. We can do this. We can reverse this all in 15 minutes." Well, it turns out that they really can't reverse this in 15 minutes. It's been, my time does fly. See, 2007 was the start of our troubles, and this is 2017. That's 10 years of temporary emergency stimulus. The Fed's balance sheet now stands at $4.2 trillion. In the day before the crisis struck, before we recognized, rather, the crisis, it was, $800 billion or so.
I think it's even 4 or 5, isn't it? I think it's even more than that. Well, it's a few extra 300 bill.
You have to keep up, Demetri. 4.2, I think you'll find.
Oh, is it? Well,
yes.
You would know better than I. You certainly would know better than I.
Well, somebody's going to check, and I'm going to have my face will be red with embarrassment. What do you say we compromise? We'll call it 4.35 trillion.
What's that between friends? Nothing. No problem.
Somebody wrote something in the Wall Street Journal, I guess a while ago, reminding us we should not bat around the term trillion so glibly, a trillion being 1,000 billion, which, to borrow from Jake LaMotta, the middleweight champion, is a lot of money even when you say it fast. But the Fed buys these bonds. It has been buying them, or it did buy them over the years, and quantitative easing, as the program was called. And how does the Fed buy bonds? That's the place to begin. Well, it buys them by creating the means with which to do it. If you and I want to go out and buy, say $1 million worth of Treasury notes that will pay us interest and to sustain us in our mellow golden years, we have to get the money. So we have to borrow it or have saved it or steal it or something. We have to come up with the money ourselves. Now the Fed, being a central bank, is not so constrained. It creates the money literally through the tapping of a key on a computer keypad. It credits the account of the seller of the bond. It says, all right, we'll take the bond, and here is the payment. We credit your account at our bank with $1 million. Tick, tick, tick. Just tick, I guess. And that's the end of the transaction. That's how the Fed makes money. We should all be so talented
it
at
does
money
that
making.
To its broker dealers.
Yes, through its so-called primary dealers.
Primary dealers.
Yes, right. So the Fed's been doing that these many temporary years. And it has accumulated from a standing start of what we say $800 billion or so, a balance sheet well in excess of $4 trillion, meaning it owns assets to the tune of more than $4 trillion. So what do we do now? Well, it thinks, before we leave this sum of money, Demetri, we might reflect on the capital that is supporting these massive assets, right? If you personally seek to go out and start a bank and acquire a lot of loans, you need what they call a cushion. You need something to absorb loss in case you miscalculate, right? And you typically, these days, they insist to the regulators that you have at least 10 or 12, better still, $15 of capital for every $100 worth of assets. That's considered presentable. Well, the Fed being exempt from many of these regulations that the proletarians are subject to, goes out and buys securities without regard to, it scarcely owns any capital, a tiny sliver of capital. In fact, part of its capital went to finance the latest highway bill maybe a year or two ago.
You're talking about the remits to the Treasury.
Yes, well, it remits its earnings to the Treasury, but it contributed to the Treasury under the Act of Congress. It contributed a portion of its capital to finance highway construction. So the Fed is a bank that presents the ugliest thing in finance since Medusa or something. The Fed's balance sheet is a fright. It's
the ultimate zombie bank.
Yeah, well, if it were a bank in competition in the real marketplace, it would not be allowed to exist.
It would be a Death Star.
Yeah, well, maybe it is a Death Star, to be pretty well said. So how does it shrink? Well, it would shrink if it wanted to shrink by selling these bonds that accumulate, or a little less. You could take its time and just let them mature. And then it gets the money, and then it remits that money to the Treasury. But notice when it does, the Treasury must still borrow, and somebody must buy the bonds the Treasury issued, because the Treasury, we call the Department of Treasury, Demetri, but actually we should call it the Department of the Debt, because there's no treasurer in the Treasury, not enough. So the Treasury is going to continue to borrow, and who is going to buy these bonds if not the Fed? That's the question.
That's a great question. That actually brings us to, I don't mean to interrupt you, it brings us to a very important question, which is exactly that. If the Fed were to leave, if the Fed were to go away, to stop, which is what you're getting at, what would happen to the bond market?
Well, the bond market would continue. The bond market existed, antedated the Fed, certainly. It will follow the Fed when the Fed makes its long-awaited and well-deserved exit from this planet. Bonds will find buyers, but not necessarily at prevailing very high prices. It's like everything else. say you're in the dress business, and this metaphor is going to get quickly strained, but you are making very, very fancy dresses, and you wonder what's going to happen to the dress market when you stop supporting the price of these garments through very, very imaginative and persuasive advertising. Well, what's going to happen? What's going to happen to this overhead supply of frocks is the price of a frock is going to fall, right? So there's too many dresses in proportion to the evident demand. Well, the excess isn't going to get burnt, or it's not going to vanish. It will get sold, but not at the hoped for prevailing price of yesteryear. It's going to get sold at a lower price. Similarly with bonds, I think. So interest rate, meaning...
That's the inverse relationship between the price of a bond and its yield.
Right. So if the price of a bond falls, that means that the interest you earn, the buyer, the saver, goes up.
Right. On newly issued debt.
Right. And because you can make a deal with already existing debt to equalize interest rates across new and aged securities, all rates will go up if the Fed exits and ceases buying.
What do you think of the proposition that absent a Federal Reserve, an economic crisis and contraction would be so extensive that even a government with a highly indebted government running annual deficits would be considered a safe haven? Treasuries would be considered a safe haven, and therefore yields would actually go down, the price of bonds would go up, were the Fed to just literally, let's say, just blow up tomorrow.
Well, we can't know, and we can't or shouldn't dogmatize about hypothetical propositions like this, but we certainly should think about them. It seems to me that if the Fed were out of business and if there were a crisis, that people would, as they have in the past, regard the Treasury as a relatively safe port in a storm, perhaps the safest port among many ports in a storm. Yeah, the United States Treasury is, it's evidently indestructible. Try as we might. The credit of the United States is a very well-founded, not necessarily on account of the prudence or the foresight of the managers of a given political administration, because of the nature of this country. It's a great country. It's an enterprising country. It's a rich country. And many assets to sell yet, many taxes to levy yet. I am a forever habitual and perhaps somewhat repetitive critic of our monetary arrangements and of our fiscal arrangements, but there's no gainsaying the success of the Treasury, of the dollar bill itself. The dollar is the world's great currency. It's the Coca-Cola of monetary brands, as we said before. It's a pretty great brand. Try as we might to debase it, the world still wants more.
I think about it in the context of Japan. I mean, that's the one, before this interview, I was trying to think about and look and see and draw comparisons between the United States post-2008 and the Japanese post-1989. And I was also, of course, looking forward, China, perhaps some other countries around the world that might be in that position. But no country seems to be in a position similar to China. And so when I was thinking about...
Thank goodness, by the way.
It's pretty terrifying.
Yes.
Actually, you seem to have views on China. I heard a wise man say once that the further one is from China, the more authoritative he or she sounds.
Oh, yes. Well, no. Expertise is reversely proportional to the distance of the authority to the subject being scrutinized. That goes without saying, Demetri. But we can read income statements and balance sheets, even those produced in the far, far east. So China's debt is twice as big as its output, and it's growing twice as fast, and never before seen have been the financial shenanigans that are going on in the People's Republic of China. That's a fact. And that is not a fact based on, fake expertise. Those are simple arithmetic.
Tell us a little bit about those facts for those in our audience who aren't familiar.
Well, China is, what do they say? It's a thing. It is the greatest, within the borders of China, is the greatest derangement of debt ever. And that incorporates the excesses of Japan in the 1980s. It incorporates our own flights of fiscal fancy here. And I mean, there's nothing like what is going on in Japan. Never has been. In China. Japan was another one. What do I mean? I mean that the recklessness of the lending and borrowing, the deceit and the lack of transparency of those debts, the sheer rapacity of the speculation, of the promoters of speculation, is historical first.
Well, the Chinese, unlike the United States and unlike any other country I've looked at, even countries like Australia or Canada, had a hiccup in credit creation and credit growth after 2008. In China, it went parabolic. So their response to the crisis, because they have such a strong control of their banking system, was to generate more credit, extend credit, and push economic growth forward.
Well, yes. So the Chinese seem bound and determined to fly in the face of every single received tenet of prudence and safe dealing in banking and lending and borrowing. Banking being a subset of lending and borrowing, of course. For example, it has been an ancient principle of banking that real estate is a very poor asset. Why? Because it is illiquid. It's difficult to realize, as they say. It's hard to sell in a pinch. American banking regulations prohibited banks from accepting real estate collateral starting in the 1860s when those regulations were first written. Unwritten regulations and usages in Britain, which got a head start in modern finance, also frowned upon real estate and mortgages as suitable banking assets. And America has loosened those strictures, so has Britain. And often we've done this to our pain and to our loss. In China, the heresy of real estate as a banking asset is not a heresy. It's considered best practice.
There's a bias towards, and not even just a bias. What you're saying is
real estate is the collateral par excellence in China of debt, and people have come to accept the very dubious proposition that real estate, no matter what it might yield, no matter how it might be priced, is a fail-proof conservator of long-term wealth. That is the belief that has infused the Chinese people. So empty blocks of apartments rise up into the air, and the collateral is thought to be fine and liquid, and it's not. It's not fine. It's not liquid, and it is going to have a very bad end.
When you look around the world, is China sort of top on your list for a possible source of the next crisis? I understand very much. I mean, it's very much in the line of Grant's and the way you write and the way you think to be very prudent and to not make prognostications. I understand without question.
Well, that's not so much prudence as it's
experience.
It's self-knowledge. Well, no. Let me say by way of preface and consumer product warning that we do tend to be early, and we got bearish on the excesses in Japan, I think, starting in, we coined the phrase Nipponomania, and I think it was not at the top. I think it was many years before that. So yes, we do expect a very noisy and scary and costly denouement in China. When? I have no idea.
And of course, China is a very different situation than Japan insofar as the Japanese market was more market-oriented than the Chinese market, insofar as the Chinese banking sector, I mean.
Well, China seems to have consolidated or seems to have combined the worst facets of regulated capitalism and communist micromanagement.
So in light of this discussion around potential sort of pitfalls, we were talking a little bit about the balance sheet, the unwinding of the balance sheet. There are many pitfalls there. There are pitfalls, of course, in China with the debt. One of the asset classes that Grant talks about often is gold. And something that you've spoken about often. We spoke about it now in terms of sort of in the philosophical sense of its role as money. And what do you say in your newsletter, and how do you think about gold's role as an investment and as a speculation? And what are you really speculating against when you own gold? Because I know you're bullish on it, and you've been bullish on it for some time.
Yeah. Well, gold is a very poor investment in the nature of it. It is money. It yields nothing. It's sterile. It looks good. We all know people like that. Doesn't say much. Looks good. Gold is I think I've said this perhaps to you personally, Demetri. Certainly I've said it before. Gold is the price of gold I see as the reciprocal of the world's faith in central banking. It's the opposite, or it's the other side of the coin of trust. I once was in a small company with Paul Volcker who proceeded to reflect on the curious faith that people vest in a piece of paper stamped full faith and credit, notes payable, satisfaction of debts public and private, whatever it says in the fine print of a dollar bill. People, I think, don't read that much more than they read the directions and come with an aspirin bottle, but people accept without a great deal of thought or analysis that these pieces of paper, this dematerialized entry in your bank account, somehow it has an innate value. Why is that? Where does that value come from? Does it come from the stamp of the government? If the Trump administration stamps a piece of paper valuable, is everyone going to accept that? Is that self-evidently valuable? Well, the world collectively has come to, I think, a remarkable degree to accept that very proposition, whether you're in France, whether you're in Japan, whether you're in Brazil. People accept the value that is said to be present in government-issued pieces of paper called currency. So gold competes against that. Gold being the legacy form of money, being the form of money that antedated all these pieces of paper, that has shown itself, gold has shown an ability over the years, the decades, the centuries, even the millennia, to hold purchasing power. Gold competes in the marketplace of ideas and of monetary preference against these pieces of paper. Also now competes against cryptocurrencies, things like Bitcoin. And gold has been has given a very, very mixed account of itself since the year 2011. It peaked, I forget now.
Just under 1,000. I'm sorry, just under 2,000.
Right, $2,000 an ounce, and now it's $1,260 or something. The dollar bill has lost about 99.99% of its value against gold since the start of the Fed in the year 1913, or effectively 1914. Gold has stood up well against any currency, but people want performance in the here and now, and they want things that appreciate in value, and gold has not given them that satisfaction. I own it. I own the metal itself. I own the mining shares, and my strategy, Demetri, is not to look at it now, because I think successfully finally persuaded myself that this is something for. I am investing in what I take to be, what I believe to be, an almost an inevitable historical outcome. Now, that's a very big, fancy statement to make, but I'm investing. Not speculating. I'm investing in the disappointment attending every single experiment in paper money down through the ages. And I'm investing in my expectation of the failure of the most radical experiment in paper money ever seen, almost imagined.
Another way to say it is, besides the idea that you're shorting central banks, essentially, but you're bullish on gold insofar as you're bearish on paper currency.
Right. I am bullish on gold because it is a play against what is going on in the central banks of the world.
And of course, that is not absent the policies of the central banks. In other words,
well, it's very much about the policy of the central bank. But I'm also making another bet. I'm betting. By the way, this word "bet" annoys me because I wrote in one of my books about a speculator named Bernard M. Baruch. That Baruch describes the time he was in the presence of the august J.P. Morgan, and they were discussing, Morgan and Baruch were discussing a proposed venture capital deal. And Baruch, speaking rather glibly in the presence of this giant of Wall Street, said that that Morgan would contribute this, and he, Baruch, would bet. And Morgan stiffened and said, "I never bet." And the interview was over. So bet. I said bet. I shouldn't have said it, Demetri, but I did say it, and I guess I'll stand by it. So what I'm betting on also, apart from the failure of these, I think, cockamamie central bank policies, I'm betting on other people besides myself and 2 or 3 good friends and my grown children espousing the same idea and acting on it. And that is a very different thing. I'm betting that people who are so used to dematerialized money, they have no idea what gold is. I'm not blaming you, Demetri, but I notice that you have that annoying millennial look about you of youth and health. and I'm betting that people who were not around when gold was last treated as money, that was August 14th, 1971, that those people too will come to see in this ancient monetary element a store of value that is not on offer from the governments of the world.
I mean, is it a fair assumption for me to make that in order for that to happen, there needs to be a currency crisis?
There needs to be a yes, there does. There needs to be a currency crisis, and I think there also needs to be a demonstrated failure of the attempt by central banks to manipulate stock markets and bond markets and real estate markets. And I say manipulate with I hope to use the word precisely. Central banks, especially the Fed, have been manipulating expectations of higher asset prices. They have used these expectations to levitate asset values to support the expansion and economic activity that we have been struggling to achieve these almost 10 years. So this was the program of the Bernanke Fed to get the stock market going, get real estate markets going, get people investing and watching their assets appreciate, and thereby inspired and emboldened to go out and spend money.
The wealth effect idea.
They used to call it trickle down. Now we call it the wealth effect.
But in fact, there can be a perverse instantiation of that. You've talked about it. I alluded to it earlier, I believe. One example, simply put, is that low interest rates and high levels of debt, private debt, can drive many sane people to want to save more and spend less.
Yes, and they can... and too much debt can throttle business activity. It can suffocate it. Just the burden of servicing debt. Look, in the case of the United States government, interest rates, I think the Treasury is paying, what 2% or less on average for its borrowings, down from 9 or 10 eons ago, it seems. But if interest rates return to the long-term average in this country, call it 6%, the Treasury would be paying interest on its substantial, immense debts that would rival the budget of the Defense Department.
Can you imagine that happening, though, within the context of having a Federal Reserve that is separate from the Treasury? Or would we need to see some kind of radical political shift where the Federal Reserve is sort of ingested by the Treasury, it comes under the Treasury?
I have lived long enough to rule out nothing in markets. The idea of a 6% interest rate on 10-year Treasury now seems impossible, doesn't it? It seems as if it were outside the realm of literally a possibility, but it existed. Looking in the past 15 years,
early 90s for sure.
There was a 14% Treasury yield as recently as the spring of 1984, and a 10% Treasury yield as recently as the summer of 1987. This is not ancient history.
But that would be catastrophic for the government.
Well, it would be inexpedient. It wouldn't be catastrophic. And just because it's inexpedient doesn't mean it can't happen. People say, well, that can't happen. Well, it would be better if it didn't happen, but how many things happen despite there being... So how might that happen?
I want to know, what does Jim Grant think? Does Jim Grant have some scenario or two that he considers to be, that he's imagined and thought that maybe this, without quantifying it, is more probable than some other scenario? Is there something?
Let me tell you a short story about how interest rates have in the past tended to move in time. Unlike any other asset market I know, interest rates trend or have tended to trend over the course of a generation. They fell for the 35 or so years following the Civil War in this country. They rose from 1900 to 1920. They fell to 1946. That was a quarter century. They rose slowly at first, then fast, then seemingly as if they would never, ever stop rising. They rose from 1946 to 1981. It was 35 years, and they have fallen and laterally have gone sideways in the 35 or 36 or 30, ever it's been since 1981. what has characterized the movement of rates in the past has been a very gradual shift as the direction has kind of almost in a geological time, as now would seem, as the plates have shifted, rates have moved up slowly or down slowly. They tend not to spike, at least at the beginning. It took, in this long trending 35-year bear market in bonds, meaning bond prices went down, meaning interest rates went up. It took interest rates 10 years to move from 2.5% to 3.5%. 10 years. Not to say it's going to go the same way this time, but so when I say that 6% is not impossible, it's unlikely of a sudden. But, we live in a world of wonders, and who knows? People have forgotten all about inflation. Governments the world over think nothing of running big deficits and printing lots of money. Maybe there'll be an unscripted inflation that will cause rates to move more suddenly than we have been accustomed to imagining they could move.
But one way or the other, what you're essentially suggesting is that rates will continue to move and budget deficits will continue to grow, and they will be enabled through the central banks. And so ultimately this will not be a crisis of nominal budget deficits declining and government cutting back nominal spending, but that in fact there will be inflation.
I don't know that. I mean, I wish you would talk to me, Demetri. About 35 years ago, I knew everything was going to happen next week.
Well, you have a great story that I love seeing stuff that you say, Jim, or watching videos of yours. You have that great story of you in 1981, or was it 1982, when you waited online to buy a few ounces of gold, and the lesson you learned, I love this. You said, I learned a lesson, which I'm paraphrasing you here, which is never wait in line to buy anything.
Oh, yes. Everyone must know this. I am happy to serve as the index case of waiting in line. It might have been, this is perhaps a little bit too evidence of personal conceit, but I like to think that I made the top in the gold market in 1980. It was January 1980 that the gold price peaked at about $850 an ounce. And it went parabolic, even as Bitcoin has recently gone parabolic. It was like $400 an ounce in the fall of 1980, 79, and it almost doubled in the succeeding 3 or 4 months. Extraordinary run. And people began to impute causation to this. They began to interpret it. Well, the gold market must know something. It must mean something. It must mean, for example, that currencies are soon to be entirely worthless. Gold wouldn't be going up except for a well-considered belief that markets know things, right? They discount the future. So people had to buy gold. And it became a must-do. And there were queues outside the Nicholas Deak, D-E-A-K, there was a coin dealer in Lower Manhattan. And I, chump fashion, stood in that line, not thinking that the thing to do was to stand in no line and to buy bonds, which to the spring of 1980, they passed 10% in yield. So they were not quite at 10, but they were at 9. So you could have locked in 9%. By the way, 9% bond was
30 years?
Yeah.
Wow.
Would have seemed a very poor bargain, because by the time September 1981 rolled around, that same bond was trading well in the 70s, or anyway, the yields were 15%, not 9%. So there are any number of possible ways to make a fool of oneself in the market, but the best way is to do what everyone else does, and the most certain way of knowing that you are where you're not supposed to be is finding yourself physically in a queue to buy a hot asset. And Demetri, I did it.
Well, okay, Jim. So before we wrap up, I wanted to also ask you, besides gold, which is something that you've written about and spoken about for a very long time, Grant's, your newsletter, does investigate alternative investment opportunities. You look for places where you might be able to get a return that is above zero.
Right. That's how greedy we are. Well, what we try to do in the spirit of not standing in line, we to change the metaphor, we run toward fires.
You want to be right later, as I've heard you also say.
Yes. This is a wonderful bon mot by Joe Robillard, who said that successful investing is about everyone agreeing with you later.
I also like this other one that you said.
But let me flesh this out.
Sure.
So we wrote about Turkey in a favorable light early this year because the problems were well ventilated, the risks were evident, and the bargains we thought were more than compensating for the true risk associated with that very troubled country. We similarly looked at Russia during when it was even more out of favor than it is now. We looked at a bank called Sberbank, which is a terrifically run institution that was being sold hand over fist. Very few ardent buyers. Sellers were ardent because oil was going down, because Russia was a kind of a nation built around a big gas station, and people thought Russia was going out of business. So these are things we try to look for opportunities where others see risk principally, and we try to look at risk where others see sure thing. So that's the plan, Demetri.
The quote I was going to say is the other one I've heard you say, which is, I certainly don't ever want to find myself saying, I used to be rich.
That's a line I borrow from a friend of mine who is in the wealth management business at Brown Brothers Harriman.
Old firm and
still a general partnership.
George Bush, Prescott Bush, I think.
Yes. And this his friend tells the story about he was a young banker there, and some Texan came in with a lot of dough and said just what you said, son. Saddest words in the language. I used to be rich. I can think of sadder words actually, but point survives the exaggeration.
So Jim, I really appreciate having you on. I didn't know how exactly I wanted to do this because every time we've had a conversation on air, it's always been about sort of the philosophy of interest rates. But I knew we had more time, and I wanted to try and see if we could give people some actionable intelligence and maybe also prod you on some other things. It was my attempt to do that, but it was really wonderful having you on. I certainly enjoyed it. I think you're a very funny guy. And I've actually mentioned to our audience before how wonderful your conferences are, and you actually have one coming up.
Oh, well,
a great opportunity.
Yes, they're all the best one ever, but the one coming up on October 10th is going to feature a conversation between me and Alan Greenspan.
A certain Alan Greenspan.
Yeah. And I'll ask him how he looks back at his time on the Fed and what he makes of the institution of paper money and what he thinks of the world of Bitcoin and like
That's
that.
fascinating. I mean, I'm very excited for that. I actually had Sebastian Mallaby on this program a few episodes ago. Yes, and we discussed it was the entire episode was devoted to Alan Greenspan. We covered his 1959 speech to the American Statistical Association, where he talked about the wealth effect and asset price bubbles. So we explored the sort of the Alan Greenspan that existed prior to the Nixon campaigns and the Ford and everything else. It is fascinating. He's a very fascinating individual to study, and I'm very jealous that you have the very fair opportunity to interview him. That's going to be very exciting. How long are you going to have him there? Are you going to have him in chains? Is he going to be locked down?
I'm going to get my
How
money,
are you going to keep him there?
Get my money's worth.
That's exciting. All right, so Jim, thank you for coming on. I really do appreciate it.
Well, you are entirely welcome. I'm always happy in your company, Demetri, whether it's theatrical or...
That's right. You came to 12th, was it 12th Night you came to, or Midsummer Night's Dream?
Midsummer Night's Dream.
You came to Midsummer Night's Dream. I really appreciate that.
I'm not sure if your listeners appreciate the fact that you are a theatrical presence as well as a journalistic one.
I appreciate you very much. That's very kind of you, and it was great seeing you there as well. So thank you so much for coming on.
You can't see it, listeners, but we just shook hands. And I'm going to shake hands with the engineer too. Watch this. Okay.
All right. Thank you so much. And that was my episode with Jim Grant. I want to thank Jim for being on my program. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforcespod.com. Join the conversation on Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforcespod.com. Thanks for listening, and see you next week.